Well, changes to Canada's controversial capital gains are now in effect, despite pushback from some who are impacted. So what could that mean for your assets? Joining us to discuss this is Peter Sashecki of Everything Financial. Good morning, Peter. Good to see you.
Good morning.
So this came into effect just yesterday. So what should people know about this change, the capital gains tax?
The rate has gone to 66.7%, but that's for personal gains over $250,000.
So if your profit from something you sell was $250 in your pocket, that's what you get taxed on?
Yeah, if your capital gain is $250,000 or less, your taxable rate, the inclusion rate, is still 50%. So 50% of that $250 is a gain, and then you pay tax on that, and it boils down to about $62,500 roughly. But on the amount of money over $250, so if you had a gain that was $350,000, 50% on the first $250 and 66.7% on the next 100 or anything over 250. It's really early for high-level math this morning.
No, you did a great job. Wow.
There we go.
That's your thing, though. That's your jam. Okay, a lot of people believe that this is mostly going to affect secondary properties. How will it impact people with stocks or other investments?
Same thing, though. If you're selling from some investments in what's called a non-registered or called a taxable account, not a TFSA, not an RSP, and you're so fortunate to have that much money in there that you make that much of a gain, then again, the tax is the same way. But there's things you can do to try and mitigate the tax, and that's what you want to do, is always trying to keep more of your money, because it's not about what you make, it's what you keep.
So in this case, you'd only be really impacted if you sell those investments or sell those properties.
If you sell that much, yes, sell in little bitty pieces maybe. When it comes to stocks and investments, you can go, well, I'll just sell this one because it's under 250. But you can even do that with a property. You can do what's called changing your adjusted cost base. Now, we don't have an hour and a half to explain that detail this morning.
Changing your adjusted cost base.
Yeah, let's put that one on the internet. So basically, you can do some tax strategies with your accountant and your registered financial planner to slowly kind of change the value of your property. So it's almost like you're selling a room in that rental property to change the adjusted cost base, which is like the purchase price, every year, and try and shrink that. Maybe look at joint ownership with your spouse or your partner so that the capital gain is split between the two of you.
Interesting.
To make it less. So there's lots of strategies. Or maybe cross your fingers, sing a little lullaby, and hope that a government change in the future maybe does away with this capital gains and goes back to the old way. We can always hope for that.
All right, well, something to keep in mind going forward. Are there other categories of people that would be mostly impacted by this? Like
It's really anyone. I mean, they say, and this is the rhetoric that politicians use, it was for the ultra-rich, with that 0.01%. It doesn't affect the ultra-rich. It affects the middle class who are trying to get ahead, maybe have a condo they're trying to make extra money out of to help their retirement. Those are the people this is truly affecting. And the economists say they've collected about 10 years of capital gain revenue in 1 week. So what does the next 10 years of political parties do for collecting tax revenue back if it's all gone? So start to develop strategies. If you missed selling something, don't panic. There are ways to mitigate the tax. You just have to plan for it.
Okay, good advice. By the way, Peter, happy birthday.
Oh, thank you.
Not
today. That's past.
Well, it was yesterday, so I want to wish you a happy birthday.
Yeah, 49 again.
And counting.
And counting, yeah. And I do the math, remember?
Yeah, it's math we can handle. Happy belated birthday,
Thank
Peter.
you.
All right, thanks for coming in.